Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hello, everyone. This is ETF Spotlight, and I'm Daniel Snyder. Thank you so much for checking out another episode with us. Today, you're going to want to hear this. We have Geneva Investor here, an analyst on Seeking Alpha, telling you something that you might not know about, because I didn't know about this. And I didn't realize that this ETF was launched actually in 2020, kind of got mixed in the shuffle for me, but it's actually around the tech sector, following the NASDAQ 100, with a lower expense ratio, actually. So I want to go ahead and bring in the man who taught me about this specific ETF, learn more about it, and figure out if now is still the right time to be investing in tech. So we are joined by Geneva Investor. How are you doing today?
Hello, Daniel. Thanks for having me. I'm doing great.
Awesome. So let's dive right in, get straight to the point. It is 2025, brand new year. Is tech still the place to be?
Yeah, it's a question, right? Personally, I think that tech, and specifically US tech companies, are as relevant as ever. These are companies that have, for starters, exceptional profitability. If you remove the Max 7 from the Standard & Poor's 500, the index actually saw flat earnings growth in the past years. And after energy and financials, tech is the industry that generated the most profits in equity markets. So unlike energy and financials, though, tech is also enjoying high growth and it is less burdened by regulations, at least so far. So that's for starters. Then also, if you think about it, tech companies are very resistant to inflation. We live in a world where higher than normal inflation and asset inflation is kind of the norm, at least, for you guys in the US, still the case. For us, Europe, probably a bit better at the moment. And these are the companies, tech companies in general are really well positioned to weather these macroeconomic trends. For example, take Microsoft, right? Most of our corporate America uses Office, uses Windows, and the switching costs to other systems are simply so much for a company that they would never even consider switching, right? And that's why they have such incredible pricing power and are very resistant to inflation. And there's also significant barriers to entry, I think, in the tech sectors. If you think about, as an investor, you want to invest in companies with a wide moat, as Warren Buffett famously says. I think there is virtually no better companies than tech companies in terms of moat. Here you can think about NVIDIA, for example. Their microchips are impossible to replicate, to the point that the fact they are producing them in Taiwan is becoming by itself a geopolitical issue, right, between US and China. So I think at the end of the day, what scares investors maybe about the tech sector is not the tech sector per se, but it's more about valuation, right? So I don't think any sane investor would say, I hate Microsoft's business, I would never buy Microsoft regardless of the price. I think they're maybe a bit scared about the valuation. So for me, the real question at the end of the day is, can you as a long-term investor, with a 10 plus year horizon in terms of investment, can you afford not to be exposed to tech today in 2025? Can you afford to wait for those valuations to go down? Can you afford to try to time the market? For me personally, the answer is no. You cannot afford not to be exposed to tech in 2025. It's simply too risky to wait on the sidelines. And people that have done it in the past 10, 15 years, they have, felt it. So definitely the way I see it is it is still, very relevant industry, very relevant for all investors to be exposed to.
Now, you mentioned Buffett and the mention of the moats and having these companies be protected in that regard, but also to mention Buffett and how he's notorious for not investing in technology, whether it's he doesn't understand it or he's risk averse to the volatility of it. There's other investors that are out there that are just like him. Why is now the time to be investing in tech if there's this whole new thing around AI and people are able to create, launch, and ship products quickly for less costs that are directly taking aim at the gross profit margins of these tech companies?
Yeah, I think it's a very fair question. And, I think the answer is, if you look at the tech companies that have generated the most earnings growth and generated the most innovation in the past years. These are not really the startups and the scale-ups that maybe you would have thought about in 10 years ago in 2015. I mean, the new Apple turned out to be still Apple, right? The new Google is still Google today. So I think that tech companies, because they are positioned and they have such big moat, they are the ones that are still reaping the benefits of new innovation. So you mentioned AI, of course, very great trend, and there will be for sure new companies in the AI space. But I think a lot of the rewards from that space will still come from those companies like Google, like Apple, like Amazon, that or Microsoft, even of course, that are still very big, but they're still generating the most innovation. So, and especially when you think about it from an index investing perspective, right? You mentioned Buffett. I mean, of course, Buffett, except for his famous investment in Apple, which I think he almost exited completely by now, he doesn't invest famously in these companies. But the reality is that I am not Warren Buffett. I think most readers are not Warren Buffett, and we cannot afford to be as good as Warren Buffett to pick the stocks. And when you think about it in from an index perspective, investing in an index that is heavily exposed to tech, I mean, that for me is still the best way to be exposed to innovation. Yeah, precisely because of what I just said. So yeah.
Amazing. Well, let's talk about what's coming next for tech, though, right? So we had mentioned AI, but questions around, innovation in the technology space. You have companies like Meta that are trying to do glasses. You're trying to see Apple with the Vision Pro, which seems to be falling flat a little bit. You see Tesla with robo cars. I mean, what is the thing that people should be kind of looking forward to this year, maybe potentially even next year, as something that it will be that immediate next growth driver for these companies?
Yeah. So, question. I think for me, it is still all out about AI. I think we still have to see a lot about it. I mean, we are at a stage now where we've seen LLMs, large language models that are, they have some applications, of course, and they've already starting, hitting the industry. I think industries like, translations or graphic designing have already been hit a lot by this innovation. But I think we are just at the start of that, right? We are just at the start, and there is a lot of talk about AI agents coming up. And for example, they will be potentially able to replace even white collar jobs. So really creating an AI employee that can replace actual humans. So I think there is still a lot coming for AI. I mean, AI at the end of the day is a bit of a catch-all phrase that was used in the last month or since the launch of ChatGPT to define a lot of different terminology in the tech sector that before was already there. And I think that's a trend that is still gonna keep going. So for me, I'm still looking at AI as the main space. I don't know if you want me to do any names, but there are so many applications that are still to come, and I'm really looking forward to see what's next.
I want to dive into what you just said about AI agents taking over specific jobs. How are you thinking about that kind of impacting the greater economy? Because if people are getting laid off and they don't find a next place to fall in and have that income coming in, how are they going to pay their rent? How are they going to pay their mortgage? How are they going to pay for groceries? How are they going to pay for their consumer discretionary items? What are you thinking about in that?
Yeah, I mean, it's a great question, right? I think for me personally, this is one of the biggest threats that society will have to face in the upcoming months or years. We'll see potentially very soon, because again, AI evolution has tended to be kind of exponential. So today we are still trying to, figure out how to use ChatGPT, but it might be even 1 year down the line, we already have AGI, right? So like AI that has the same capabilities of a human, right? And that can really replace jobs. So I mean, for the technology as it is now, I think that AI is not yet substituting massively jobs, is really more complementing it and increasing the productivity. So that's a good thing. And for what we see so far, I really think that, you still very much need a human input and a human control over AI. You cannot have anything taking over. If we're going to go to a point, and if we're going to do it quickly, where there are AI agents that can take over completely jobs, then that's a very big issue. I mean, there's been a talk about universal basic income, for example, coming up, or stuff like that. But of course, that is going to have a massive impact on society and on job creation. So I wish I had an answer for you that is very straightforward, but it's going to be interesting to see. But at the moment, with the current technology, I really see AI as something that is enhancing productivity, increasing productivity, and it's not replacing jobs yet.
Fantastic. Let's talk ETFs. right? So when
Yeah.
people think about NASDAQ, they think about the tech space, they think about the QQQ ETF, one of the biggest names in the space, crazy amount of assets under management, sort of a low expense ratio. I think it's 20 basis points if I'm familiar enough with it. You found another ETF that you told me the other day that you sold all of your QQQ and you put it into this new ETF. What is this ETF and why did you make that choice?
Yeah, so the ETF is QQQM, so it's the Invesco Nasdaq 100 ETF. It's basically the same as the QQQ Invesco Trust. The difference is the expense ratio is lower, so it's only 0.15%, so it's 5 basis points lower than QQQ. It's exactly the same. It's a Nasdaq 100 ETF. It means that it's investing in the top 100 companies by market cap of the Nasdaq. And I mean, of course, I think maybe people listening might be wondering why would Invesco launch two ETFs that are so similar, right? And I mean, obviously, I don't know the answer because I don't work there, but I can imagine that the reason is QQQM is really targeted towards investors that are more looking at the longer term investing. So they really buy it to hold it for a longer period of time. While QQQ is still an ETF that is targeted to maybe daily traders, so people that anyway are trading a bit more often. For starters, there is options available on QQQ that QQQM doesn't have. And also it's a bit more liquid. So QQQ is still a great option, right? And you mentioned, I think it's the fifth largest ETF in the world at the moment, very successful for Invesco. And I think it's still a very good option for investors that are maybe a bit more on the active side or day traders. QQQM for me is a no-brainer for anyone that has a bit more of a longer time horizon in terms of investment, because again, you're just saving 5 basis points in expense ratio, and that really accumulates over time, especially if you're talking about 10, 15, 20 years of time. So and I think one of the reasons why Invesco launched it is also because they want to be competitive, right? At the end of the day, ETFs have seen a massive inflow of money in the last 10, 15, 5 years. Passive investing is on the rise, so obviously Invesco wants to make sure that there is no one else launching a more successful Nasdaq 100 ETF than them, and that's why they launched it. I don't think they are alone in doing that. I think recently I've seen also Grayscale doing something similar for the Bitcoin fund. So I mean, at the end of the day, they don't want to lose, of course, their main ETFs that generates a lot of money for them, and there's a lot of AUM, asset under management. But they still want to be competitive, so that's why they end up launching a parallel ETF. But from an investor perspective, I mean, it's a no-brainer really. If you are holding it for at least 5 years, I would say why paying 5 basis points more, right? QQQM is the place to be in that sense.
Yeah, very solid point. Sounds like the Bogle effect still kind of creeping into the ETF market, driving those expense ratios down as much as possible. And I think they realize that. That's a very interesting point. I was looking here on Seeking Alpha, just at the two symbol pages for QQQ and QQQM, noticing that the factor grades are a little bit different. The quant does have a buy on both of them, but the risk grade is a little bit more favorable for the QQQM. I'm guessing because of what you're kind of talking about. I mean, assets under management of about 41 billion almost, versus QQQ, which has the 320 billion, but more of that trader's dynamic, right? So very interesting highlight that you're bringing with us today, or bringing to us today. Geneva Investor, thank you so much for highlighting this to us today. Obviously, people go check out QQQM. That is been highlighted here today. We look forward to have you in the next episode where maybe we can dive into some other ETFs, maybe in the crypto space or wherever else you're kind of looking. I know you're kind of all over the place and you have all of that great analysis on your author profile here on Seeking Alpha. So Geneva Investor, everyone, take care and we'll see you in the next episode of ETF Spotlight.
Thank you. Thank you for having me.